start off with 2.12, right? All right, awesome. Okay. Right now, I noticed that not too many people are watching my YouTube videos, which is kind of touching. But but I'm like, you know what? When the test and the exam draw nearer, I feel like the viewership will go up quite significantly, which is also fine. All right. But I'm truly glad that the sound is a lot better, because yeah, I was even considering getting a different device just for the sake of that. So that's, yeah, been great to hear. And this is BCom Group 1. Okay, awesome stuff. All right, so let's get into, I see 2.10, which I gave you for homework, was really just the theory side to what we spoke about in terms of markup percentage and gross profit, sorry, markup percentage and what is this? Gross profit percentage or gross margin, okay? But I'm happy that you guys obviously went through that. And then 2.15, I think we'll talk about that when we wrap up class. All right, but for now, let's get into 2.12. 2.12, under the required, it says, show how the above transactions affected the accounting equation and enter how the accounts in the general ledger will be affected. Example, received a capital contribution of 50,000 in the form of cash. Okay, right, so pretty much the same thing we did with 2.11. Then it says the following are miscellaneous transactions for super suppliers for January 2011. Ignore VAT. The business uses the perpetual inventory system, all right, method, which is what we've been using all along. We will get into the periodic just now, okay, within this session. Then it says markup 30% on selling price. Ooh, okay. All right, note the markup is not quoted as a percentage on cost. Okay, so they're even giving you a hint. Okay, refer back to question 2.10 for more information. Okay, we don't need to do that. We will proceed. Okay, so we know that. So you guys tell me, let's build our model. Remember, I always said the first thing that we need to do before going any further is to then build our model. So we know that the markup is 30%. So if markup is 30%, what do we know automatically is also 30%? Profit, 100%. You want to say the same thing, I'm sure. Okay, profit is 30%. Thank you so much for that. 30%. Okay, right. But we know that within the question, we need to at least be given sufficient information to know two variables, right? Okay, so then how do we find the other one? Yes. Selling price is going to be 100. Why is it 100 though? It's as simple as that. It's as simple as that. The fact that they said on selling price, therefore selling price is 100. Thank you very much, sir. Okay. Selling price is 100. Okay. So now that we have the two, how do we work out the remaining one? You just subtract. Okay. Exactly. Thank you for that. That is then going to be 70%. We now have our model. We can now tackle our question. Guys, do not try to do this after. Please just do it first. Okay? Write it out, please, as well. You'll see how quickly it can begin to get a bit tricky. Okay? I know now it's like, oh, it's pretty straightforward. Great. I'm happy that is the case. But when you start to play around with that, play around with all these other things, it can be a bit, it can get a bit confusing. So please just make sure that you actually write it out on a piece of paper. Okay? There could also be marks there, by the way. Right. Then on the first, what happened? They didn't give us any opening balances, so we can get straight into it. The owner contributed a desk, office equipment to the business, valued at 2,000. Okay. Right. So which accounts are going to be affected there? Assets, yes, and capital contribution. Okay, 100%. All right, or owner's equity. All right, cool. So here we're going to put plus 2,000, and they're also going to say plus 2,000. Okay, here we're going to debit. What is this? Office equipment. Actually, office furniture. It's not equipment. Okay. Yes. You contributed what did you contribute? A desk. Okay, well, if they put office equipment in brackets, then I guess go with office equipment. If they didn't do that, I would have gone with furniture personally. Okay, but let's follow. I know that for sure, if they put something in brackets, they're basically telling you it is office equipment. Okay, thank you for highlighting that. See, I told you guys that I also learned from you. All right, so office equipment, right? And then here we know we're going to credit capital. Okay, right, then we can move on. What also happened on the first, it says the owner took trading inventory for personal use. Selling price, 3,000, okay? So here we can already just put in the accounts quickly. Debit drawings. And here we're going to credit. Oh, sorry. Actually, we should do it like this rather. Here we're going to credit trading inventory. And here we're going to debit drawings. Okay. Right. Now they gave us the selling price. They didn't give us the actual. So we need to work out cost. Remember the formulas, what we want. What we want is cost. And we know cost is 70%. What we have, though, is selling price, which is 100%. Right? Times, what is this random amount? 3,000. And what does that give us, guys? 2,100. Thank you, sir. Okay. So that's for on the first. All right. So now we can record the amount. Here it's a negative 2,100 because assets is going down, and here it's a negative 2,100 because we know drawings reduces owner's equity. Okay. Then on the 8th it says purchase trading inventory on credit. We purchased trading inventory on credit 10,000. Okay, that's fine, no problems there. We know assets is increasing by 10,000. Okay, and that's going to affect trading inventory. So here we're going to debit trading inventory. Okay, and then we know we bought this stuff on credit, so liabilities is going to increase 10,000. And then we're going to credit creditors control. Okay. Right. So that's what we did on the 8th. On the 10th, it says purchased an office computer for 6,000 cash. Okay. So here we know office computer is obviously an asset. Bank is also an asset. So what do we do? This is going to be a plus minus. What was it? 6,000. Okay. And here we're going to say we're going to debit office computer. And we are going to credit bank. Okay. Right. That is what happened on the 10th. On the 15th, we had credit sales of trading inventory, selling price 11,500. Okay. What do we want? We want cost. What do we have? we have selling price. Let me do this in a different color. So here, let me try and squeeze it in there. What we want is cost, which we know is 70%. What we have is selling price, which we know is 100%. Oh, and guys, don't attach the percentages to anything, because as you can see, selling price can also be 100%, cost can also be 100%. It could literally be anything, okay? Then what do we have? Rand amount. How much were these goods selling for? 11,500. Okay, so then what now is the cost? 8,050. Okay, sounds about right. Yes, thank you very much. And we come here and we say, well, firstly, we know we were selling, so we're dealing with the sell part first, and we sold for cash, right? That's 11,500 on credit. Okay, okay. So that's going to affect debtors, not bank. All right, we're together now. Okay, perfect. Just wanted to make sure I hit the record button. Okay, perfect. All right, then we know this is also going to affect sales, which is owner's equity. Okay, sales. And that account we are crediting, because we know incomes, we credit them when they increase or incur, or in what are realized, should I say. Then we go to the accounting for the trading inventory, right, which we know is going down, so that's going to decrease assets, and we calculated the cost to be 8,050. Okay, cost of sales as well, going to decrease owner's equity, 8,050. Okay, so here, trading inventory, what are we going to do? We're going to credit. So can you see what I was telling you guys earlier? How accounting is foundational. First, we were just teaching you guys about the different accounts and what belongs to which category. Now, we're at a place where we're showing which accounts are affected, all right? And then obviously now we're debiting and crediting, okay? So we've come a long way, even up until this point. I'm just going to put cost of sales, okay? So keep on putting in the work like I know you guys have, because it's going to pay dividends as we do more and more stuff, or more units, should I say. Okay, so that is what happened on the 15th. Then we move to the 27th. Cash sales of trading inventory, selling price 9,750. All right, selling price. Okay, so again, this happened on the 27th. Use a different color. Okay, nothing has changed. We want the cost. What we have is the selling price, which is 100, and that was for 9,750. What do we get? What do we get? 6,825. All right, thank you, sir. Okay, right, we have that. Now we can jump into our question. Now here it was cash sales. Okay, so this time bank is affected. So let's just write this out. And I'm going to show you something very interesting now. All right, we know that sales is affected. We know that trading inventory is decreasing, so we're crediting that. And then we also know that we're going to debit cost of sales. Okay. Awesome stuff, right? How much did we sell for? 9,750. So that's going to be a plus because our bank is increasing. Plus. And then here we know we're losing trading inventory, and that was for 6,000. 825. 825. And 6825. All right, there we go. Okay, cool. Now this is the thing that I wanted to show you that's very interesting. Whether we made sales on credit or for cash, can you see that all the accounts remain the same? All the accounts remain the same. The only thing that changed was bank. All right, here we had debtors. Okay, so that's another quick way to, you know, just save a minute or two in the test or exam. You know that sales is going to be credited, right? Because it's an income is going up. Cost of sales is going to be debited. It's an expense. We're incurring it. Then trading inventory is going to decrease because it's an asset and it's going down as a result of the sale. Then you just, is it bank or is it debtors? Okay. This is assuming the sale, whether on credit or cash, is of trading inventory. Okay. If it's a sale of something else, I haven't seen them actually make you do that, but then it would change because then trading inventory wouldn't be involved or stock wouldn't be involved. Okay. All right, let's go on. 27th, paid telephone bill, 2,300 cash. All right, simple stuff. We know that here we're crediting the bank, and then obviously here we're going to debit telephone. Good. Telephone. Okay, that was for 2,300. 1,300. Then last transaction, received rent income. Okay. So here we're going to debit bank, and here we're going to credit rent income. Okay. And how much was that for? 3,000. Positive. So now I'm sure you guys can see why I was saying, guys, if you see the accounting equation, regardless of what shape or form it comes, you should be just saying, these are my marks. Okay? These are my marks. We've dealt with this, okay? We've dealt with this. Obviously, you guys can practice doing it in the general ledger. In question 16 also, they ask you to do the general ledger. Okay, so please do that. Okay? They, in question 16, they also really put you to work because they give you a different markup for certain transactions and stuff. So, yeah, but I think that won't give you too much of headaches because I think we've dealt with it quite comprehensively. Okay. Are there any questions in relation to what we have done with this question? Is everybody happy? We can move on. Okay, cool. Right. So we are finished with markup and gross profit percentage for Unit 2. Okay. Now, the last thing that I want us to touch on in Unit 2 is the periodic inventory system. We spoke about the periodic inventory system when we were going over the theory of Unit 2, but now I want us to quickly do 2 exercises. And I think I'll focus more on the differences because everything else pretty much stays the same. It's really just when we start to play around with inventory that you'll see the transactions are slightly different. Okay. Let's start with exercise 2.13. I hope I have it here. Exercise 13. Do I? Yes, I do. Okay, awesome. So there we only have 3 transactions. And those transactions, again, they're just focusing on where inventory is involved. Okay, because everything else would remain the same. Okay, so let's read the required. It says, show how the above transactions will affect the accounting equation and enter how the accounts in the general ledger will be affected under 1, the perpetual inventory system, and then under the periodic inventory system. Example, received capital contribution of 110,000 in the form of cash. Okay, right. It's just giving us an example of how we should enter it out. Okay, cool. We're only going to focus on the periodic because I think we've done a lot of perpetual. Okay, so you guys should know exactly what we need to do there. Okay, let me close that and zoom in. Okay, so there we are. On the 13th, okay, it says the following transactions, amongst others, appear in the books, all right, during March 2007. Okay, purchased inventory on credit, 18,000. Now remember what I told you guys about the periodic inventory system. When it comes to the periodic inventory system, we don't have a trading inventory account. Which account do we then have to use whenever we purchase? It's not assets. And which specific account? Which specific account? Which specific account? Because we know the specific account we use under the perpetual would be trading inventory. Under the periodic, what would we use? Yes? Yes. Okay, it's purchases. And purchases is not an asset, it's an expense account. Okay? So let's see how this is supposed to be recorded. Okay. So we won't even go to assets. Okay, we'll go straight to owner's equity. Because remember, purchases account is a expense. So here, let me actually start with that. We're going to debit purchases because we just incurred an expense. Okay. And then here we're going to put a negative. How much did we buy these goods for? 18,000. Okay. Then we're going to go to liabilities because we owe someone. We bought it on credit, right? We didn't buy it for cash. And so here we're going to credit creditors. And here we're going to put a plus because now we owe someone. Our liabilities are increasing. And can you see there? If we weren't too sure about what it is we were doing, we go to our accounting equation and we see 0 is equals to negative 18 plus a positive 18. So we should be good. Okay. Okay. So yes. In the anybody have an answer to that question? Yes? Do you guys agree with him? Do all our assets fall away? Do we no longer have computers, desks, cars? Do they all fall away? Huh? Why would it? No, I said we don't have trading inventory or stock or merchandise as an asset. We have it as an expense. Not to say that all the other assets fall away. Okay, so everything else is the same. It's only how we treat trading inventory that changes. Now, to answer his question, he's saying, is there any other account that falls away? And I love the question. Is there any other account that falls away under the periodic inventories? Hands up. Yes, it's the only account that falls away. Everybody's going to vote. Otherwise, I'm going to ask you personally why you didn't vote or what your answer is. Okay. So you guys say it's the only account that falls away. The rest of you? Is there another account that falls away? Just wanted you to raise your hand. Okay. Okay. Guys, if you don't vote, I'm going to ask you to answer me, like give me, dialogue, because you didn't say yay, you didn't say nay. You don't know. Okay, who doesn't know? Some of you are double voting here. All right, cool. So the answer to your question is it's not the, yeah? There we go. Cost of sales also falls away. We only calculate cost of sales at the end of the financial period. Just like we only calculate the actual trading inventory that we have or stock at the end of the financial period. So those are your two accounts that typically fall away. Does it make sense? Okay, great question again. Okay, but let's go on So it says here, paid 2,000 from petty cash for railage on purchases on trading inventory, or sorry, on inventory purchased on the 13th. Okay, so here's another thing that takes place. Now, remember the other time we did an exercise and we had delivery expenses, and we took that to the trading inventory account. All right, but now we don't have the trading inventory account. So now this railage becomes an account in and of itself. All right, and it's an expense account. Okay, so how do we record this? We're going to go to owner's equity. We're going to debit railage on purchases. If you just wrote railage, I'd give you your marks. But typically, they would want to see railage on purchases. Okay, it would be the same for import tariffs. Did I spell railage wrong here? Okay. My PC is just acting up then. All right, it would be the same thing for import tariffs. It would be the same thing for, I'm trying to think of any other expense in relation to, yes? Carriage on purchase is the same thing. Yes, thank you. All right, so here we put a negative 2,000. All right, and then remember it said we paid from petty cash, right? What is petty cash? Is it an asset or what? What is this thing? It's an asset. So this time we're now coming here and we're going to have a negative 2,000 because our assets are decreasing. And here we're going to write petty cash. All right, and they were crediting it. Crediting petty cash. Okay. All right. So first we saw how we do things in the books when we purchase it. And if we had bought it for cash, we would have simply debited bank. Oh, sorry, credited bank. All right, under asset. If we had bought this trading inventory for cash. Okay. All right. Cool. All right. Then last transaction on the 22nd said sold all the inventory purchased on the 13th for 27,000 cash. Ah, interesting. Let's see. So we sold it for cash. Therefore, we know that we're going to, bank is involved, and we're going to debit bank because we're receiving money. It's increasing. It's an asset that's increasing. So here we're going to say plus 27,000. Okay. I seem to always put an extra zero. I like money too much. Eh? Yeah. And then what has transpired here? We made a sale. Okay. So we're going to credit sales. Okay. This we're used to. This is not brand new, right? This is not anything new. 27,000 over there. Right. Now, can we account for cost of sales? Can we account for trading inventory going down or stock decreasing? Can we? We can't because we don't have a trading inventory account. We don't have a cost of sales account. All right. So when it comes to the periodic inventory system, we would only do the first double entry, which is the recording of the sale. Does it make sense? If we had sold this stuff on credit, what we would have done, we would have debited debtors control. That's it. That would have been the only difference. And then we would have had credit sales. Okay? Right. Okay. So that's how can you see what they did? They showed us how we treat whenever we purchase trading inventory, whenever we have expenditure relating to trading inventory, all right, how we treat it. Those are separate accounts, separate expense accounts, okay? Separate expense accounts. And then finally, when we sell trading inventory, all right, so it covers all the scenarios that you would have in relation to trading inventory, okay? And then remember this thing, every other transaction, all right, which wouldn't then pertain to trading inventory is treated the same under the perpetual and the periodic. Everybody happy? Okay, cool. Right. Then this is what I'm going to do. Okay. This is what I'm going to do. I wanted us to do activity 2.6 together. So what I'm going to do is, I think it's better just to maybe show you guys the answers, and then we're obviously just going to go through each transaction together. So I'm sure our brains have had quite a workout today. Let me zoom in a little bit. Hope that helps. Let's do this. So we can see more clearly. Okay. Okay, that's probably the best I can do. Okay, cool. So, right, as I said, here we're operating under the periodic inventory system, all right? Now highlighted in yellow are the transactions which are not, maybe we hadn't experienced them in any of the other exercises, okay? So that's why I highlighted those in yellow. It says we paid a rent deposit, 500 Rand, all right? And 1 month's rent, okay? And then it goes on to say 500 in advance to the rent agency, okay? So when you see this, again, guys, break down your transaction. Deal with them one after the other. So first things first, we paid a rent deposit, 500, okay? Now, some of you are obviously renting out your own place, because I know maybe you're coming from Durban or you're coming from Cape Town, wherever else. Now, when you put down a deposit, that money is going to come back. You're going to receive it when you now say, okay, I'm done leasing this place. Can I please have my deposit back? Right? The deposit is just there in the event that you break something or that you don't pay your rent for 1 month. Then they'll take the deposit. That's why. Okay. So this is an asset to you, because assuming that you don't break anything, you're going to get the money back. Does it make sense? So how we then treat this is, obviously, bank is going to decrease, so we're going to credit the bank, okay? And then rent deposit, all right, which is an asset account, because we're going to get the money back, all right, is what we then debit. And that's why you have plus minus in assets, okay? Then we move on. We pay 1 month's rent, okay? That's obviously going to decrease our bank again, so we're crediting bank. And then rent expense, okay, so it's affecting owner's equity. Negative, negative. Everybody happy? Okay. Then finally, no, that's fine. That's it. That's it. Okay. Then we can move on to the next transaction. So these guys are in the mattress business. We purchased a foam mattress, all right, on credit, okay, for 1,200. Subject to a trade discount. We've seen this before. Okay. But now, because we don't have a trading inventory account, we use the purchases account. So purchases account gets debited, and then creditors control gets credited. Okay. And there you can see purchases an expense account, so we minus owner's equity. All right. For the amount after the trade discount. Okay. And then finally, for liabilities, we did the same. We just added, because now we owe so much, but on the same amount of 1,020 Rand. We sold merchandise on credit to F Flower, 600 Rand. Okay, can you see? All that we've done is we've recorded the sale. Debtors, because this person now owes us, was debited, and then sales was credited. Plus 600 in assets, plus 600 in owner's equity. All right. Then what else did we go on to do? We paid water and electricity account, 340. Okay. So obviously, if they don't tell us whether we paid for cash or on credit, we know that we can assume that we paid for cash, always. Okay. If they don't tell you, then you can assume we paid cash. All right. So then we know bank is affected. Okay, we're going to credit bank because we're losing money, and then water and electricity we're going to debit because it's an expense and we are incurring it. Okay, negative 340 in assets for bank, negative 340 in owner's equity for water and electricity. Then we move on. Next transaction, the owner took an antique grandfather clock with a cost price of 2,500 and a selling price of 4,500. All right, for personal use, and withdrew 250 cash. Okay, hey, this owner is having a field day. Okay, right. So again, here they're just trying to test. Do you know that drawings needs to be recorded on the cost price? Okay, so drawings, all right, and then purchases. Can you see we didn't use trading inventory? We used purchases. Okay, this is an important one because we didn't get something like this in the exercise we did just now. Okay, so drawings is affected, and then purchases is affected. Okay, can you see plus minus over here? Plus minus over there. Okay, why is it a plus minus? Somebody tell me. Why is it a plus minus on this transaction? What is plus and what is minus? Yes? Okay. Do you guys agree with him? The pluses, drawings, and the minuses, trading inventory, or purchases in this case, because we don't have trading inventory. Do you guys agree? Okay, hands up those who agree. Okay, hands up those who disagree. I'm tired of hands up those who don't know. Okay, because I want you to take a position. Is either right or is wrong? Hands up those who agree. Hands up those who don't agree. Okay, so what are you guys? Where do you land? Okay. All right. So the plus is for purchases, and the negative is actually for drawings. Okay, so well done to you. Okay. What happens whenever we make purchases? Remember, it's an expense, right? So it decreases our owner's equity. So now if we're reversing a purchase, what must happen? We must add it back. Does that make sense? Okay, so that's why it becomes a plus for purchases. Okay, and then the negative, we know that drawings, whenever there's drawings, it's going to reduce owner's equity. Does it make sense? Okay, so that's why that's the way it is. Okay, right, great. Then we also had, he withdrew, he did drawings for cash, 250. Okay, so drawings again, we're debiting bank this time because it's cash. Okay, negative there for drawings, negative because our bank account is decreasing. And then what happened? Settle sleepy suppliers account. Okay, in other words, we paid. So we just need to look for sleepy suppliers account. Oh, I was looking at this 300. I should have been looking here. All right. So we obviously, yeah, we need to go to previous transactions to find out how much we actually paid. All right. So that's another test. So if you had put in 1,000, how much was it before the 15% discount? 1,200. You also would have lost marks there. Okay, because obviously you have the wrong amount. Okay. Awesome stuff. Then F Flower paid half of the amount owing on his account. Okay, how much did he owe? He owed 600. That's how we have our plus minus. Bank is increasing, debtors is going down. Okay, makes sense? Then finally, we had paid the monthly installment on the bond. Okay, 750. Okay, the amount was made up as follows. We have a capital repayment of 650 and interest 100 Rand. So here, they're testing your knowledge on the fact that when it comes to a bond repayment, you're with each installment, you're paying a portion of interest and a portion of capital. Okay, we know that The interest we treat differently. The interest we treat differently from the capital, okay, that we're paying off. So, firstly, let's deal with the capital that we're paying off. In other words, the mortgage loan, okay? Should probably use that so I don't confuse you. The mortgage loan. Now, the mortgage loan we know is a long-term. Sorry, no, it's a current liability, okay? Because we're paying this now, okay? So under liability is going to decrease 650, okay? And then bank is going to decrease as well. And that's why it's negative under assets 650. Okay. Now interest, this is interest expense, okay? And that's why it's affecting owner's equity, because interest paid or interest expense is an expense, okay? And we know all expenses affect owner's equity. Okay, so that negative 100 under owner's equity. And then again, our bank is decreasing by 100 Rand. Okay. Again, what you could have done is you could have just said bank negative 750. Okay, and then just split these two up. But once again, I think it's always best to just split everything up. But whichever method works for you. Right. That said, that's your exercise 6. All right. So we've literally done everything in relation to unit 2. Okay. Now the last thing that I want us to do is the exercise that you guys had, which was question 2.15. All right, and fortunately, there's no number crunching there. It's just theory. They give you guys 2 companies, okay, and they say, assume you are an investor contemplating a possible investment in one of these 2 companies based on the information provided. Which company would you regard as the best bet? Okay, write a few notes on the importance of disclosure of relevant information in the financial statements. Okay, so these companies are exactly the same, or for the most part, well, quite similar. Let's say that, not exactly the same. Under your assets, all right, your total assets for both, you have 8 million, 8 million. For company A, you have 3 million current assets. Company B, you have 4 million current assets. Company A, you have 5 million non-current assets. Company B, you have 4 million non-current assets. Okay, then we go down. We see under liabilities for company A, non-current liabilities, we have 3 million. And for company B, under non-current liabilities, we have 4 million. For company A, under current liabilities, we have 4 million. For company B, under current liabilities, we have 3 million. And owner's equity is the same for both. Okay? Right. But then our owner's equity plus our liabilities for both companies, both equals 8 million. So now we ask ourselves a question. Which is the better company? Which one should we invest in? If we had to pick one of the 2. You said company B. Who says company A? You say company A. Okay. Why do you say company B?
I said it because they have a larger current liabilities, which means in a year they need to, which means in a year's period they'll have to pay that, and then to cover that they'll probably have to sell some assets of it. Basically.
You said company B, right?
Yes.
All right. All right. And why did you say company B? I mean company, yeah, you.
I said because although they've got the higher current liabilities, half of that year is paid off, they've got less non-current liabilities, so you're going to get another full investment half of the first year.
Uh-huh.
I also expect to the company pay off that non-current liability, which means, well, for us, it means that they make more money in the year the company.
Mm-hmm. Okay, interesting. what leads you to believe that they'll manage to pay off their current liabilities? Is there any information that alludes that or gives you an indication that they'll manage? There's nothing. Because literally this is all they gave us. So all our assumptions need to be based on what they've given us. So the company that you should actually be going for is the one with the less current liabilities. Okay, which is company B. Okay, and I'll explain much to what he was saying. Okay, the only bit that you spoke about was selling off assets. Okay, and I think here you need to be a little bit more specific. So remember, our current assets includes the money that we have, all right, includes our trading inventory, okay, includes our petty cash, okay. Anything that we know within 12 months is either cash or near cash. Does that make sense? So we have 4 million in current assets in company B, and we know our current liabilities is now any money that we owe that we have to settle within this 12-month period. Okay, right. So with company B, we already know that based on our cash and near cash, we will be able to pay our current liabilities. Okay. However, in company A, when we look at those amounts, there's going to be a shortfall. Does it make sense? All right. And what you're saying is not off. We could be maybe making money in income, right? But we don't know that for certain. We're only using the information provided. Okay. So based off of that information, we would take company B. Okay. What you also said in terms of the loss also is a healthy argument. But again, we don't know if we're going to survive this year. So if we don't know, if we fail to survive this year, then we won't realize those profits. And the other problem is, what would then happen is, since our current assets is less than our current liabilities in company A, we would then have to go and sell our equipment, our furniture, the non-current assets in order to settle that 1 million in current. And that sets us back because now we don't have the machinery and the equipment, the furniture, etc., to actually conduct our regular course of business, which then becomes problematic. Okay. All right, guys. So that is it from my side for today. We have finished Unit 2. So the next time I see you, which I believe will be online next week, we will be doing the theory to Unit 3, and then we'll probably jump into some exercises from Unit 3. Unit 3 is not as long as Unit 2. We took our time here because literally this Unit 2 is so foundational to your understanding. All right.